Alright guys, so economic Armageddon is right on schedule and China has had enough. For over the last 24 months, the US has been hammering away at the Chinese economy. The first was the chips war. The US banned advanced semiconductors to Beijing. Then came Biden's tariffs on Chinese imports, which was a big wake-up call. 100% import tax on EVs, 50% on Chinese chips and solar panels, and 25% on other critical exports coming into the US. And if we zoom out, we can see the US has been cutting away their reliance on Chinese imports. Since Trump started the trade war in 2018, China's share of US trade deficits have been collapsing from nearly 50% during Obama's term to 26% in just 5 years. The US is importing more from Canada, Mexico, the EU, and Asian countries like Vietnam. And if you're sitting in Beijing, you know that free trade with the US is over. That era is done. You can just toss it into the bin. Donald Trump's second coming is a confirmation of this reality. China is an export giant, is the world's factory, and for decades, they've been relying on US money to grow their industries. And this chart tells us how profitable trade has been with America. China's trade surplus with the US was almost $400 billion at the peak. It has fallen to just under $280 billion today. Imports to the US are dropping faster than American exports to China. And this is a big problem because even if China sends their goods to the US through proxies like Mexico, it will still hammer their margins. A gadget that yields a profit of $20 could get cut in half after going through an extended supply chain. And this leaves China with a very big dilemma. Building your factories in countries like Vietnam could be a solution, but even Southeast Asia isn't 100% safe. Chinese companies are setting up solar factories in Thailand, Vietnam, and Malaysia. However, US companies are lobbying Washington to crack down on these as well. So that option is also moot. China has thrown the spaghetti on the wall and they have come to one realization. The only way to sanction-proof our economy is to boost domestic demand. Instead of banking on the markets of the West, China has to rely on their own consumer base. Europe also can't be relied on. We all know they are following Washington on their tariffs on China. The decoupling, guys, has begun. So it's no surprise that Beijing has signaled a much bolder stimulus for 2025. The Politburo has committed to take moderately loose monetary actions conditions next year. Now, the Chinese readout basically confirmed what we have been speculating for months. China knows Trump's return is a minefield. At the very least, a 10% additional tariff is coming, and at worst, triple digit taxes could be imposed. It's important we look at the statements made during the meeting. It gives us a deep insight into how China really plans to revive the domestic market. China is helping to make conditions looser, and if things get desperate enough, we could actually see cash injections to boost consumption. Firstly, the Chinese premier has pledged to deploy every means possible to boost consumption. And if we observe the actual spending done from January to October, the rise has only been around 1%. So we can expect more government spending to flood the Chinese economy in the final quarter and extend well into 2025. China simply has no choice left. They have to start issuing more bonds to stimulate the economy. And when the second biggest economy in the world starts easing, we have to pay attention here. Now, this is the big question. Is this sustainable? Will it blow up in China's face like the US? And this is where we have to make a distinction between the situation in the Chinese economy versus the West. Firstly, China is flirting between deflation and inflation. Consumer prices are up by only 0.2%, while producer prices are still in the negative zone. Manufacturers in China are seeing their input costs go down. Producer inflation fell by 2.5%, and this means the threat of continued deflation is still higher than inflation. So the last thing they have to worry about is higher prices, and this gives the government a very big runway to start splurging. Secondly, Chinese interest rates are very low, especially compared to the US. China's 7-day reverse repo lending rate is at 1.5%. In the US, it's well over 4%. Meanwhile, the 1-year prime rate loan is at 3.1%. For US banks, it is at almost 8%. And this is crazy low, and the Chinese are about to slam it down further to boost spending. We could be reaching the bottom of the property collapse, and once this reverses, consumer spending will soon follow. Let's not forget 70% of household wealth in China is tied up in real estate. So reversing the trend of falling prices is paramount. To boost domestic consumption, China has to stabilize property prices. There's simply no other way here. The policies to support the housing market are starting to get really aggressive, and it's a strong start to reverse the demand collapse. China is lowering the deed tax to 1% for first and second home buyers of smaller homes. At the most, this will only go up to 2% for bigger houses. So Beijing is encouraging people to buy more. In addition, China is scrapping the distinction between ordinary and luxury homes. So upgraders are going to benefit a lot from this. And if you decide to sell your homes, value added taxes will also be eliminated. This is an unprecedented move to boost home sales. The barriers are starting to calm down. If China can revive their domestic demand, they would eventually overtake the US economy. It's just a matter of time, which means we could be at the bottom of the Chinese market now. Trump coming back into the Oval Office means a protectionist shift. And if countries decide to hit the US with retaliation tariffs, the big winner would be China. Since 2019, China has been the biggest trading partner to over 120 countries. For the US, it's only 56. And that's why Trump's tariff threat is a big gamble. He could win big or he could lose very big as well. Countries hitting the US would mean they have to rely on a new consumer market. So China reviving domestic demand is going to create a new big outlet for the world to sell into. But let's talk about an economy that's the exact opposite of China. And the situation in Germany is getting worse, and their days as a manufacturing hub, well, it's getting numbered. If you're an industrial giant, you need two crucial factors to survive and thrive. You need cheap manufacturing inputs. Well, Germany doesn't have access to cheap gas anymore. You also need big markets to sell your products to, and that's another strike on the German economy. Trump is closing the market off while China isn't happy with the EU tariffs either. And it's so bad that even Olaf Scholz is scolding Volkswagen, telling them not to shut down factories in Germany. Now, I don't know about you, but this sounds extremely tone deaf to me. The company isn't cancelling production because they're making tons of money. They are shutting things down because they are losing money. Schultz is blaming poor management decisions, but there's also something to be said about poor geopolitics as well. And this is how bad the situation is. We have tens of thousands of workers staging a walkout. Volkswagen is suffering from a series of rolling strikes. They're going to cripple the company even further. And if you need a statistic, here's one for you. This will sober you up. 66,000 workers have walked off from their jobs. Three factories could be closed, and demand for EVs in Europe is destroying the demand for cars. They don't want cost cuts, people are very angry, they don't want a factory shutting down. And these are high paying jobs, and replacing them would be nearly impossible. The problem with these shutdowns is the domino effect. German industries are so interconnected that a VW collapse would spell disaster for other related companies. Volkswagen is not just the biggest employer in Germany, it's also one of the largest customers for other companies in the automotive industry. A ton of vendors rely on VW money to survive. Bosch is the biggest auto parts supplier in the world, and their biggest customer is in crisis. As a result, they are also on a layoff spree. 5,500 jobs will be cut globally, and the worst hit, to no one's surprise, is Germany once again. 3,800 jobs on German soil are done, and this is probably just the start of the mass firings. According to the company, the automotive industry is suffering from significant overcapacity, and that's code for a collapse in sales and margins. Bosch provides the parts for VW, but if domestic demand is toast, plus China is taking global market share, your sales would plummet. And here's the issue with Europe, especially Germany in particular. They don't want to confront the elephant in the room, and that is finding cheap alternative energy. They keep dodging the obvious like it's Voldemort or Sauron. No amount of financial engineering or trade barriers can reverse deindustrialization. Germany They are trying to use a washing machine to cook lunch. Schultz is now calling for the EU to protect the steel industry. He basically wants tariffs to prevent an overcapacity of steel from entering Europe. But in reality, no one really cares about emission friendly steel. The majority of consumers around the world, even the US, all they want is cheap and affordable steel. He's trying to take a page out of the US trade war playbook, but there are big fundamental differences between Germany and the United States. Firstly, the US consumer market is much bigger than the Germans. Secondly, the US has the power to get financing from the world unlimited because of the dollar. Germany can't vendor finance their own economy without breaking their debt limits. The only way out is to lower your cost of production. And this chart tells us all we need to know about Europe's energy crisis. Even a blind monkey can understand what's going on here. In 2021, only 24% of Europe's gas imports came from LNG, and that's the most expensive type of natural gas. But in 2023, the percentage has now shot up to the moon. LNG is now 42% of Europe's gas mix, and in Q1 this year, it's over 43%. Doesn't take a genius to understand why EU industries are in crisis mode. What's amazing is how long Europe has managed to sweep this problem under the rug, but sooner or later they will have to confront it. In 2025, Trump is going to make it impossible to play hide and seek any longer. It's a sink or swim moment for the EU. But let's circle back to the US China trade war for a bit. It's vital we understand the consequences of China's stimulus push. As China's domestic consumption rises, exports to the US would naturally fall off, and certain products are about to get much more expensive. And if you live in the US, maybe it's time to stockpile these items. The US imports a ton of electronics, machinery, and appliances from China. Over $250 billion worth of these goods comes from Chinese vendors, a quarter of a trillion. And if this gets grinded down to zero, we'll see consumer inflation spike higher. So prices throughout Walmart, they're going to go higher. And you best believe other exporters will raise their prices as well. China might very well lose a ton of market share in the US, but that doesn't mean it's a victory for Trump. It just extends the supply chain even further. The biggest losers, once again, will be people like you and me, the consumers. Well, we always lose. But let me know what you think. Will China's stimulus plan work? And can Germany dig itself out of this hole? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.